Hello and welcome to today's episode where I have invited Connie Louie from New Zealand, who is an expert in international and cross-border taxations from the perspective of New Zealand tax laws. And her experience comes from working at one of the top firms in accounting and taxation, including Baker Tilly, BDO, and Deloitte, where also I come from. So today's episode, we have invited her to understand from her, from a New Zealand's expat perspective, if someone wants to leave New Zealand and wants to move abroad and probably optimize their taxes, what would be the requirements, what would be the processes, and how can we go about doing and achieving the zero tax status that we usually try to achieve when someone is moving to Dubai from these countries. Hi, Connie, and welcome to the show. And can you just give us a brief background about yourself?
Certainly. Thanks so much for inviting me to join this webinar. It's a pleasure to be here today, and thanks for having me. What you've mentioned is a great introduction and summarizes my background and my firm. As you've mentioned, I am an international tax accountant based in Auckland, New Zealand. I've almost 15 years of tax experience and had worked at Deloitte, Summit Tier, as you've mentioned, and a boutique international tax firm called NZUS Tax Specialist. And my firm specializes in cross-border taxation for migrants, property tax, tax disputes and resolution, and small medium enterprise tax. We offer both New Zealand tax compliance and consulting services in-house. Yeah.
So, Connie, I want to start with a question about what does it mean to be a non-New Zealand tax resident?
So, non-New Zealand tax resident, it means that foreign source income is not subject to New Zealand tax, and only New Zealand source income is subject to New Zealand tax. So that's kind of the tax residency fundamentals lies, and that's kind of the tax base for New Zealand.
Thank you. And can you also briefly explain what are the requirements and the process of becoming a non-New Zealand tax resident? Do you have to leave the country, or you can still be in the country and become a non-tax resident? How does that work?
Yeah, so under New Zealand domestic tax law, there are two main tests to be a non-New Zealand tax resident. So the first test is called the day count test. So the person needs to be out of New Zealand for more than 325 days in any 12-month period, and they have to lose their permanent place of abode. So permanent place of abode is a concept that is not defined in the black letter law. So IRD have released some commentaries around this as to when a taxpayer they will consider as acquiring a permanent place of abode or not. Factors that they would consider includes like family or social ties, employment, business or economic interests or ties, location of personal properties, and location of main home. So these are all the factors that IRD will look at and determine what ties you have still with New Zealand, and then determine have you actually lost that permanent place of abode when you depart from New Zealand. And those are the two key tests.
Okay, so if I repeat or that I understand correctly, you said 324 days, that's almost like 1 year or 11 months that you have to be outside of New Zealand.
325 days.
325 days.
Not. Yeah, it's almost a full year, but not quite the full year.
Not quite the full year. Okay. So my next question is, can you tell me, like, I understand you have said 325 days of period that you have to live outside of New Zealand, but overall, what are the timelines that we are looking at in terms of becoming a non-tax New Zealand resident, including like once, let's say we start the project and then there's the period where the client will leave, 11 months of 325 days of non-tax residency outside. Can you just give us like a brief overview of what are the timelines that we are looking at where we can say the client no longer has to pay taxes inside of New Zealand?
As a scenario, say, the taxpayer departs from New Zealand to live in Dubai permanently, and so at the point he leaves New Zealand that day, he will be absent from New Zealand for more than 325 days, and he would lose his permanent place of abode here, because I would expect that he's all the ties he will become very strong in Dubai, like his house will be there, his immediate family will be there, work will be there, his personal property like furnitures and car will be in Dubai, and ties with New Zealand will be minimal or even nil. So then, in that case, it will be very clear that he's a non-New Zealand tax resident from the day he departed from New Zealand to Dubai, as an example.
Okay. And in terms of, so you're saying from the day that he departed from New Zealand, so let's say it can be 2 months from now, but what about the 325 days rule that you originally mentioned? Like, does it does not have to lapse that 325 days to fully complete this process?
Yeah, so 325 days it needs to lapse, but then it takes the non-New Zealand tax residency it backdates it from the first day of the
Okay.
325 days. Yeah, going back to that example, because the taxpayer leaves New Zealand to Dubai permanently, and we know that the 325 days will be satisfied. So then it will be the first day that he or she leaves New Zealand, and that is the day that they become a non-New Zealand tax resident.
Okay, and how do you notify the tax authorities that the taxpayer has become a non-New Zealand tax resident? What's the process involved with the?
Some people either just call the IRD and ask some question, and then maybe they, luckily enough, maybe they could get that to be up, the tax residency status to be updated by IRD that way. But usually what we find is that there is a form called the IR 886, which is a New Zealand tax residency questionnaire. That is a kind of a 4-page form that kind of asks what sort of ties they still have New Zealand or not. And that taxpayer will go in and complete the form and then submit to the IRD, and IRD will respond saying that yes, we agree that you are no longer a New Zealand tax resident, or they disagree that the taxpayer has still retained the New Zealand tax residency. So that way you can get written confirmation from the IRD that they still consider you as a New Zealand tax resident, or that they do consider you as a non-New Zealand tax resident. So that way that you get 100% certainty that, because you get a written confirmation from the IRD. IRD is the New Zealand Tax Authority, in case that
Of
wasn't
course.
clear.
And the timeline that we have discussed of becoming a non-tax resident, right? This notification to the IRD, at what point are we going to have this notification or telling to the IRD?
I think it would be good to do it before leaving, so then the taxpayer knows that of what is the tax status, and if they need to let the bank know, or the or any other third party that they receive income from, they will need to update the tax rate to a non-resident tax rate. Otherwise, the bank or the income provider may still think that they're still a New Zealand tax resident, and then the tax rate that they apply to their income is not at the correct tax rate. So it would be good to sort it all out before they leave. Then they won't need to sort it out overseas and try New Zealand parties while they're overseas. So and when they leave New Zealand, they got a clear mind that they know that what they need to report in the tax return, or maybe they don't need to file any return because they leave New Zealand and doesn't derive any more New Zealand source income. So yeah, so it'd be good to know it before they leave, I think, and sort it all out before then.
Sure. Thank you for clarifying that point. Okay, so my next question is, how can someone prove that they have moved outside of New Zealand and they have a permanent place of abode somewhere outside the country?
I mentioned about some of the permanent place of abode factors that IRD would consider earlier. So, for instance, it would be no house available to live in New Zealand. So that that kind of supports that the person doesn't have a permanent place of abode in New Zealand. The other factors that we look at, like where are the personal belongings, that, like such as car and furniture. You want to make sure that personal belongings are overseas, and that would support that the permanent place of abode is overseas. And working overseas, so all the employment business ties are with overseas than with New Zealand. and also immediate family and social ties are with the overseas country and not with New Zealand. So in your case, could be Dubai, that all these ties are with Dubai than in New Zealand. So that would kind of support that the person doesn't have a New Zealand permanent place of abode here anymore.
Sure, thank you. And my next question is, so once someone has moved out of New Zealand and become a non-tax resident, do they still have to do any sort of tax filings in New Zealand?
The answer to that question is yes and no. It depends on the taxpayer's income sources. If they become a non-New Zealand tax resident, they are now living in Dubai. But if they still receive New Zealand sourced income, then they'll still need to file a New Zealand tax return declaring the New Zealand source income. Whereas if they are only deriving non-New Zealand source income, meaning income that source outside New Zealand, then there's no need to report it to the New Zealand tax authority, and therefore no need to file a New Zealand return. So it depends on the types and sources of income, and that would dictate the answer to that question.
Thank you for clarifying that. And I have a connected question to it. That we in Dubai we usually operate under the free zone company, and the free zone company helps us structure the business in a more tax optimized manner. But now my question would be, how can we make sure that the income from the free zone company that is owned by the New Zealand taxpayer who has now become a non-tax resident, but how can we make sure that the income generated in this company it does not comes under the tax bracket of the IRDA?
So I think there's two key points here. First of all, we need to ensure that the UAE free zone company doesn't derive any New Zealand sourced income, because if there's still New Zealand sourced income, say, then it will be still subject to New Zealand tax. And when it's New Zealand sourced business income, then it's likely that that company will have a permanent establishment in New Zealand for New Zealand to have the right to tax it. So under the double tax agreement, the permanent establishment includes a place of management, a branch, an office, a factory, a workshop, like a mine, and even an agricultural property. It can also include having employees in New Zealand concluding contracts on behalf of the UAE free zone company. So I think the UAE free zone company needs to be careful as to whether they've seen any employees to New Zealand, or have a place of management or branch or office physically in New Zealand, and to get out of that being taxed in New Zealand. So yeah.
Okay, thank you. And also a related question that many clients who then move out of New Zealand, instead of selling their home, they would turn it into an investment or a rental property. So with that, like it's still a property that they own, it was still their home. How does that affect? Because you said there should not be the permanent place of abode, but they have their original house. It's just that they're no longer living there. It's turned into an investment property. Does that stops them from becoming a New Zealand tax resident? And if not, then how can they convert it into a rental property? And what would be the tax structure if they do so?
So if you have a New Zealand rental property, say still living in Dubai, we need to look at what is the connection that the person still have with New Zealand. Like talking about going back to the permanent place of abode concept. What are they family ties? Are they work ties? Are they personal belongings still located in New Zealand? And all of this will kind of look at then the whole picture and determine, does this property actually is it the permanent place of abode for that taxpayer or not. If we go with the scenario where that if the taxpayer leaves New Zealand and move to Dubai permanently, and that New Zealand home becomes a rental property, and they do not intend to go back to live in it, then that rental property shouldn't be considered a permanent place that's already rented out and is no longer available to the taxpayer, and the person does not have intention to live in it. If we compare that scenario to another scenario where the taxpayer only moves to Dubai for work, but then the family is still in New Zealand, and maybe he would come back to live to visit his family at that time, and then also or for whatever reason also live in that rental property, and say kick the tenants out, whatever, then there may be some risk that IRD consider that may still be a permanent place of abode for that person, that person, because that person is returning to New Zealand to live in it from time to time, and maybe on a continuous basis as well. So yeah, so it really needs to look at the taxpayer circumstance and whether they're actually gonna to return to live in the property again in the future or not, and also their ties with New Zealand, is it still quite strong or not. So very fact specific, kind of to look at each case.
Sure. And my next question would be, is there a concept of exit taxation in New Zealand? Someone is leaving New Zealand, like as you said, at the point where we will notify the tax authorities on now we are becoming a non-tax New Zealand resident. Is there a process of calculating an exit tax on the property holdings, investment holdings, shareholdings, some unrealized capital gain taxes? Is there any strategy, or is there anything that calculates a final exit tax that they have to pay, or is it something there in New Zealand that works like that?
I'm not aware there's an exit tax that is explicit in the Act, but I do understand in the Income Tax Act 2007, there are sections that may result in adverse tax implication when the tax residency of a company and a trust changes. So you can maybe call it exit tax because there might be some adverse tax implication when the tax residency of a company um, or a trust changes. So yeah, so just be mindful for those who holds investment vehicles.
So what I'm understanding is there's not an explicit exit tax, but if the tax residency is changing, there could be some taxation impact based on the change of the status.
Change of the tax residency status of the company or the trust, there may be. Yeah.
Okay, thank you for the response. And my next question is that can you tell us about some of the misconceptions that people might have when they think of becoming a non-tax New Zealand resident, and what could be the implications here?
I can think of a few at the top of my head right now. So, I've seen taxpayers they've mistaken that once they leave New Zealand, there's no tax return that needs to be filed for New Zealand tax purposes. But if they actually still derive New Zealand source income, they still need to file a New Zealand return to report the New Zealand sourced income. So that's one thing. The other thing I've also have seen is that when taxpayer leave New Zealand and think they're non-New Zealand tax resident, they continue to, if they have to file a New Zealand return, they continue to use the IR3 form, which is a New Zealand tax resident individual tax return form, instead of the IR3 NR, which is a non-New Zealand tax resident form. So getting those form right for the right status is important. Because it's part of that right disclosure. And also, I think conversely, some people started using the IR3 NR form, the non-resident form, instead of the IR3 form in the year of departure, which is not right, because in the year of departure, they should still use the IR3, which is a New Zealand tax resident form, because they were they were a part year resident, and it's only when the next year when they were fully when they are a non-New Zealand tax resident for the full year, that's when they should use the IR3 NR form. So that was another thing that we've come across.
Sure, thank you for that. And can you also tell me, is there like a checklist that you provide while working with your clients who are departing from New Zealand in terms of, the income, the businesses, the place of abode, and how does that looks like?
We would refer the client to complete the tax residency questionnaire, and we would review it to ensure that what they kind of put into the form, and when they submit to the IRD, they will get the non-New Zealand tax resident status that they're after. So that's usually a good checklist in that form for us to review their circumstance, and to give them advice on how we can get non-New Zealand tax resident status for them based on their circumstance, and with the hope that we could get that for them. And
Okay, thank you, Connie, for this insightful interview. I'm sure it would be much helpful to our viewers who are looking to become non-tax New Zealand resident. So my final question to you is, if someone wants to contact you in discussing the same, how can they reach you
So you can contact me through email, so Connie at nztaxprop.co.nz. My contact details are on my website, and that is nztaxprop.co.nz and spelled nztaxprop.co.nz.
Thank you for your time, Connie, and I look forward to working with you.
Thank you, Shiraz, for having me. My pleasure.
Yeah, bye-bye. Have a good day.
You too.